Right, good morning, everyone. Thanks for joining us. My name's Dave Rees. I'm the managing partner at Convergence. Really appreciate you being with us and taking time out of your day. As you're no doubt aware, our guest this morning is Kiwibank Chief Economist Jarrod Kerr. Great to have you with us, Jarrod. Almost actually a year, almost to the day, I think, that you shared your market outlook for 2025 with us. I think it's fair to say at that time, we were sort of amid the economic doom and gloom. It's a great opportunity today to update, just to see what's happening and focus on the year ahead. All of this is coming off the back of yesterday's OCR announcement and the February monetary policy statement, so that's going to add a little bit of interest into the mix. The format is Jarrod's going to give us a bit of background to where the economy's at. So how did things actually track after his last update 12 months ago? He's going to give us some insight into where we're currently at in the cycle, and then crucially, the outlook over the next 12 months. So lots to dig into. I should, just before we get going, I should mention we've got the chat there. We're going to run for about 40 minutes, and then we'll move into Q&A before we finish up. So if you've got questions along the way, please don't hold back. Feel free to put them in the chat almost as a placeholder, and then we'll get to them at some point as we run through. But maybe just to kick off, Jarrod, back in 2024, which feels like a million years ago now, where we're all hearing sort of survive till 25. When we met 12 months ago, I think you picked that we'd need to wait until the back end of 2025 before we started seeing the beginning of a recovery. So maybe just to set the context, can you kind of narrate for us how things tracked last year and how we got to where we are now?
Yeah, so last year I would put down as a year of frustration for all of us. 2024 was the recession, and we thought, okay, we're going to be climbing out of the recession in 25. You know, like you say, there was that kind of mantra, let's survive till 25, and then let's talk about, you know, thrive in 25. So we did survive into 25. And I think this time last year we were saying, you know, the first half of the year is not going to be that great, but the second half things will pick up. Well, what actually happened was the first half of 2025 was terrible. We actually fell back into a recession, and it was a deep one. The second half of the year we did improve, but, you know, off a much weaker base. So when I speak to businesses, the main message from them was it was not a good year. They thought it was going to be better than 2024, as we all did. But for many businesses, it was actually worse. Things got worse last year. So it was one of those, don't mention green shoots anymore, because every time you mention green shoots, they seem to die. And, you know, that's kind of the feeling, I think, coming into this year, because we're starting this year with the same sort of message. You know, it's going to take a little bit of time, but there are green shoots. There are signs of recovery, and the second half of this year is going to look, you know, much, much better. So, yeah, I guess the message I've got from clients is stop saying green shoots. We're not allowed to say that anymore. Let us know when we've actually got, you know, some decent growth. And we're not there yet. Things have definitely turned. Interest rates are finally at a level that I think are enticing. And I think that, you know, we do actually grow at a reasonable rate, particularly in the second half of this year. So a year of frustration, I think, between, you know, when we last did this and now, but hopefully, you know, a much better year ahead.
That's good to hear. Is it possible to point to, you know, what were the factors that killed off those green shoots? You know, what prevented us from getting the growth that we thought was coming down the pipe?
There's quite a few things that sort of happened. You know, the Reserve Bank did not cut fast enough. They mucked around. They sort of paused and thought about it, and, you know, gave mixed messages to markets. You know, had they just cut straight to 2.25 earlier last year, then businesses would be working with, you know, enticing interest rates a lot earlier. We've only had interest rates down at levels that I think is stimulatory since November. It's not that long. So the Reserve Bank, had a large part to play in that. Just the fact that they've misread the economy and were so slow to react on the rate cuts. You also had international factors at play, like you had Liberation Day. That threw a lot of uncertainty into financial markets. Global growth forecasts were being slashed. Businesses, even domestic businesses in New Zealand were looking, going, what does that mean for me? Even the people that aren't exporters were sort of worried that this global shift was going to impact them. So there are a few things at play, and there are a few things at play now with the election coming later in the year.
Yeah, absolutely. So when you look at the stance of the Reserve Bank through last year, you were a big advocate of getting lower faster. What was the rationale from their side of taking their time about it? Is that easy to establish?
I think that they were legitimately worried that inflation was going to bounce back, and you know what? Here we are, and inflation has bounced back a little bit. The bounce back in inflation's all been driven by stuff that you can't really control from a monetary policy perspective. It's like council rates, insurance premiums, electricity, a lot of these things, fuel, a lot of these things, you're not going to influence with an interest rate. But they came through nonetheless, and we've got an inflation rate of 3.1, whereas they wanted it at 3. They wanted it at 2. It's not a massive miss as far as I'm concerned, but it is a source of frustration. And I think they just thought that they were getting nearer a stimulatory rate where they weren't. It took them a while to figure out that they needed to go to a stimulatory rate, and that the stimulatory rate was well below 3%.
So how close to where we should be are we right now? If you characterize the economy as it sits right now, what are you seeing?
Yeah, look, I'm a little bit more go for growth. So I think, look, 2.25 is about right. That's what we were originally out there screaming and pounding the table saying, get it to 2.5, get it to 2.5, because neutral's 3 and we need to be below neutral in a stimulatory setting. So, we were banging the table, and then as it turned out, we ended up needing an even lower cash rate because it took them longer to get to where they needed to be. So the longer you take to do something, you end up having to do more. So we've got a cash rate at 2.25, and that's coming from someone who'd been screaming for a stimulatory rate for a long time. It even came in below us. Where would I have it? I might have actually just gone, you know what, we now need it at 2, but not a massive difference from where we are now. We are noting that businesses and households are sort of rolling off onto these new rates, and there's a big sigh of relief for many of them, particularly homeowners with debt or small businesses with debt. So, they're rolling off onto better rates. What I'm wanting is that next step where businesses go, okay, rates are where they need to be. Now's the time to take on those opportunities that are out there, leverage up, start investing, start hiring again.
Yeah, do you feel the conditions are in place? I mean, rates are one thing, but do you feel that other conditions are in place to drive that confidence?
Oh, I'd love to see a lot more on a number of other issues like macro-prudential policy, so DTIs, LVRs, that sort of stuff that restricts the amount of credit that can be created by banks. I would be a little bit more liberal there. I would also look at reducing the capital burden on banks, because we've accumulated a lot of capital, but we're being asked to accumulate a whole lot more, which is not necessary and goes well beyond international best practice. So just making sure that there's enough credit in the system because the credit in the system is the oil in the economic engine, and if that seizes or is a little lumpy, then obviously the engine is not going to run very well, and in bad times it actually seizes. So I'd do more there from the central bank's perspective. If I was in government, I'd be doing more on infrastructure spending, getting more and more of that done. Unfortunately, it's hard to do with 3 yearly election cycles. Very hard to do in your sort of election campaign year. So yeah, there's a lot of things that need to be done, but yeah, it's hard to do in an election year.
Yeah, totally. I guess the saving grace is that it's the back end of this year, being November. It gives a greater window of opportunity to before that uncertainty arises. Anything else that you've seen? What are you seeing out there that you think is particularly encouraging? In terms of the current position we're in.
So things are still very mixed, like really mixed. We look at our card data, which is a really good high frequency. I mean, we get it daily. High frequency data. The spending over November and December was good. Like the Black Friday, which turned out to be an entire month, with a lot of spending. And then Boxing Day, there was also a decent spike in spending, as you'd expect, but even compared to prior years. And then we've just looked at the January data and gone, oh, so they spent money in November, December, and then January's just kind of dropped off a cliff. So, it's this green shoot that, maybe not yet. So we're still waiting for the consumer or the household to recover. And then you look at the labour market and you go, well, it's improving. There's more jobs being created, but we've still got a high unemployment rate. We've still got a really high underutilization rate. So people may have a job, but they're not getting the hours that they need, like their hours have been cut. Hours worked is increasing, but still down. And I think that's really hurting household budgets, right? So until we see that really improve, I'm not convinced that we can put a stake in the ground and say the economy's recovered. We've seen a decent pickup in confidence amongst businesses, which is great. We're starting to see signs of investment coming through, which is great. But it's all really early days. It's all really early stages. So things are pointing in the right direction. It looks like the recovery is sort of broadening out. It's not, just our exporters doing really well. We're starting to see signs of, tourism doing really well again, but manufacturing, even a little bit of retail coming up off the ground, and even a little bit of construction coming off the ground. But for everyone in construction that I speak to, for every one person that says things are looking better, there's another person saying things are worse. So construction still, it's going to take a long time.
Yeah, it's interesting. We found that over the recent period where, if you think back to the GFC, it was kind of everybody was sort of performing badly. Everybody was finding it difficult. Whereas this recession has been quite hard to characterize in the same way, right? Because whatever sector you look at, there's actually been companies that are doing pretty well in there, and there's been a lot of companies that are doing really badly. So, as you say, when you look at the environment right now, it's quite hard to pick because there's just such a lot of mixed messages there from what we see.
Yeah, absolutely. And I have a lot of fun doing these CEO Institute syndicates where you get to go into a room with 10 CEOs from very different companies, and I give an economic update, but then they discuss what's happening, in their businesses. It's really, really fascinating. And you really mixed messages from them. Half of them are, on their hands, not hiring, not investing. And then there's like 2 or 3 that are actually still retrenching, so laying people off still. And then there might be only 2 that are actually on the other side going, well, actually, we're hiring a little bit more. We've been sitting on our hands for so long. We've actually just got to do something now. So that seems to be the mix, right? There's a couple, acting in a positive way. There are a couple still laying people off, and then there's a bunch in the middle that are just highly uncertain and just waiting.
Yeah, I mean, you mentioned that sort of labour market slack that currently exists. Should we look for that to get to a certain figure before we can be more confident about recovery? Is that a decent indicator of sort of us emerging out of the current state?
Yeah, yeah. And for me, it's not the unemployment rate. Everyone looks at the unemployment rate because it's pure and it's simple, and we all know that 5.3%, is much higher than the 3.2 that we had. Tells you the story. There's a lot of people out of work. For me, it's actually the underutilization rate. So on top of an unemployment rate of say 5.3, you add people that have a job but don't have the hours that they want. So they've had their hours cut over this recession. You add those two together, you're at 13%. So that's really high. I want that back below double digits before I start getting excited again. And to see that it's those businesses turning around and going, okay, we've cut your hours from 40 per week to 30. We can now get you back to 40 because, our business is humming along again. That to me is the key number.
Yeah, yeah, absolutely. So when you think about the monetary policy statement, the OCR announcement, I think was pretty much as everybody expected, just kind of holding tight. What did you see in the NPS that you think was interesting? Because I guess new Reserve Bank governor, we're kind of looking for signs of sort of style or outlook. What in there was of interest to you?
Oh, well, I'm an economist, so every word was interesting for me. But for 99.99% of people, I think, just the fact they kept rates on hold and signaled that they're going to keep rates on hold for quite some time was the main message. You've had a bunch of economic commentators come out and say, wholesale rates have gone up. They're factoring in rate hikes, so therefore there's going to be rate hikes from September. You had one commentator saying rate hikes from May. Well, Anna Bremen, the new RBNZ governor, and the NPC just came out with a massive bucket of water and just threw that on all that commentary and delivered what I thought was a good statement. I liked the way it was broken up. I liked the way it was simple. I liked the messaging. And we all walked away going, okay, that's exactly what we were thinking. The economy is recovering. Yes, fantastic. We've got some good signs of that, but it's early stages, very early stages. So we're not going to jump all over this recovery through a little bit of fear of inflation. It's not happening. She made it very clear that even the slight lift in inflation that we've seen, most of it you should be looking through and not ignoring, but looking through. They're one-off kind of increases and very firm forecast that inflation is going to fall to 2% by the end of the year, which is bang in line with our forecast. And that's a very strong message to send to people, right? There's, you see an inflation print and then a whole bunch of these kind of armchair commentators come out and say, well, it's going back to 7%. No, it's not. It's still going to 2%. It's just taking time. So I think the messaging yesterday was really good. And the reason I know it was really good is not because I liked it, but because financial markets liked it. So we had wholesale rates falling before the RBNZ statement, and then after the statement, they kept falling. So a lot of those rate hikes that traders had put into our wholesale rates were removed. And that's job done, like fantastic, right? The Kiwi dollar didn't really react to it. And you look at that and you go, okay, job done.
Yeah, it's that kind of soothing message, which doesn't. We don't want to create any ripples at this point. We just want to sort of calm the waters and make sure that people are feeling more confident about going for growth.
Yeah.
Is there anything else in there that's sort of revealing? I mean, as I say, sort of first monetary policy statement from her. So anything that you kind of see in there that's sort of revealing about her style?
Look, I think as she said in the chat afterwards, the way they do things at the Riksbank in Sweden very similar to how we do things here at the RBNZ. So I think it's been a relatively smooth transition for her to go from the Riksbank to the RBNZ because they are quite similar. And I think we saw that in the statement. Like there was nothing. I thought it read a hell of a lot better. I thought it was a lot easier to get through. You know, better language, easier language, clear message. Not like the shambles we had in November, where they delivered one message and then contradicted themselves with another message, and financial markets. They cut the cash rate and financial markets went completely the other way. Absolute shambles in November. Yesterday, cool, like really cool, like it. And I like the way that she threw water on the inflation expectations side of things. She was very clear. We're laser focused on inflation. Yeah, obviously that's the mandate. But at 3.1, it's a little bit above our band, but we're not worried. It's going to 2. And I think coming out with a really strong message, particularly on that inflation bit, that was well played.
Yeah, absolutely. Particularly as consumers, we still see electricity prices spiking. We still see food prices up there. So to have that messaging, I think is positive. When you look ahead, then over the next 12 months, I think when we spoke last, you were sort of picking, getting to 3% GDP growth. What is your sort of forecast from here for over the next 12 months?
You know what? It's very similar to last year. Last year just disappointed us. For all the same reasons, we've got another 2 to 3% growth this year in terms of GDP growth, and 2 to 3% house price growth thereabouts. More importantly, inflation falling to 2%, and then the unemployment rate peaking this year and starting to fall next year. So we should see a 4 handle in unemployment, hopefully by the end of this year, but more likely as we move into next year. So going from like a 5.3 down to like 4.8, and then hopefully 4.5 next year. So all of these things moving in the right direction, but there's no fear of the post-COVID bounce. There's not that much stimulus in the economy.
All sounds pretty positive. Is there any sort of major risks or any sort of watch outs? When you look at the economy now, that you can, it all sounds really favourable. It all sounds like we're poised for good things. But what should we be cautious about, if anything? What are the sort of key risks?
I think that, on any given day, any given year, you have to look offshore. What risks are there? Through our trading partners. So you look at China. China's really weak at the moment, so they're really struggling to recover. Their property market has been in crisis. They're pumping money into the economy. It's not quite picking up yet. So you look at that and you go, there's got to be less demand for our product and services, although we haven't seen that yet at all. We're still getting really good dairy prices. We're still getting really good meat prices and other things. Like our exporters are doing really well. But I think that's our one big risk, is that China, has another year of really struggling, and that may wash up on our shores. I do like the fact that we're trying to diversify away from China, but that's more of a medium-term story. You can't, I guess, go a day or a week without something coming from Trump or his administration, and then you're sitting there going, well, what does that mean for us? luckily, everything that he's done so far hasn't meant a lot for us. There's a lot of noise coming out of that administration, and you sit there and you go, how bad were the tariffs? Not that bad at the end of the day. After all of that and all of the over-analysis that we had to do as economists, at the end of the day, 14% increase in tariffs, meat's exempt, kiwi fruit's exempt, didn't hit us much at all, and it didn't hit our trading partners as bad. So there's a lot of noise out there, and that I think that plays on people's minds. I am a little concerned about the election, just how sensitive people are to the election. I don't think that would be the case, had our economy been running at 2 to 3% already, the recovery being well underway. I think we would go into this election, with our heads up rather than our heads down, and we wouldn't be so hypersensitive. We are hypersensitive because the economy is so fragile and businesses are really worried if we get a change in government. What does that mean? That's just another headache I have to deal with. Are they taking, capital gains tax forward? Are they going to remove interest deductibility? Are they going to, do you know what I mean? So I think because people are kind of on the sidelines, it's keeping them on the sidelines.
Yeah, although to what extent does that fear of instability create stability? We're so worried about change that it drives no change, right? And we've got 9 months between now and the election for us to, drive that growth forward, which is, more likely to mean no change.
Yeah, well, I guess that's a really good way of putting it. All that change leads to no change. I think for many businesses that might be the case. I think businesses will wake up at the end of this year and they will be feeling better than what they are today. And I think that's the main thing. I think their confidence is lifted off low levels and they're looking to the future with a more positive lens, most of them. Some are acting, most aren't. And I'm just hoping that growth, activity fuels activity fuels activity. And by the end of the year, we might be running at 2 to 3%. And I think businesses would look back and go, great. We thought that would happen in 25, didn't. It happened in 26. We're happy. And, almost the day after the election, maybe they'll breathe another sigh of relief. Either way, to be fair, if National stays in or there's a change in government, National stays in, obviously it's that certainty. Things aren't going to change a lot. If Labor comes in, maybe they'll look at it and go, oh, it's not as bad as what we had feared either.
Oh, yeah, okay. Well, what's driving your view on that? I mean, typically it causes a source of sort of instability and uncertainty. So what?
It does, and I'm just saying that after it's done, people might turn around and go, okay, that's not as bad as we'd feared.
Yeah, interesting. Yeah, definitely agree with you about that sort of cautious optimism that's out there. We noticed probably September, October last year, businesses talk a lot more positively. Growth hadn't been on the agenda for the majority of them over the last 3 years, and we just sort of saw signs of life. Growth had almost been a dirty word up until that point, but we're seeing a lot more projects being initiated. We're seeing plans for hiring coming through now, which is all to the good. Still pretty patchy though. There's I guess the last few years have been characterized for us by really high applicant numbers for the jobs where we advertise. I think you mentioned just before we started the webinar, you were seeing much the same thing still coming through, but it's not quite as strong as it was, which means there's more activity out there, and candidates are finding positions. We're even seeing multiple offer scenarios, which we hadn't seen since post-COVID. So all of that is,
multiple offers. What do you mean by that?
So candidates getting multiple offers on the
candidate
table.
getting
Yeah,
multiple offers.
yeah.
Yeah, right.
Which is over the last few, we haven't seen that really since that post-COVID boom.
Yeah.
So those sort of rubber hit the road type real world outcomes are
Yeah.
I think a good sign that that things are moving in the right direction.
Yeah, I mean, as we mentioned earlier, we're hiring right now, and we had, for an economist position in a team of 3, so it's a small team, quite different to the other banks. And we had 111 applicants, and they were serious applicants. That excluded, people from overseas who didn't have a visa. Most of these applicants had degrees in whether it's economics, finance, or something relevant, even other sciences. So strong candidates, a lot of them. It took us ages to go through the CVs and get it down to a top 15 that we are still interviewing now. So really strong candidates, a lot more than we thought we'd get. And I was joking with you before about AI. AI has been used a lot in generating CVs, fine. Generating cover letters, not fine. The funny thing is that what people do is they take the job ad, they throw it into their AI to generate a cover letter. What they don't realize is that 30 other people are doing the exact same thing, and it's pumping out the very, very similar cover letters, very, very similar wording, and it makes it very, very easy for us to just get rid of those. If you can't be bothered writing a cover letter, we can't be bothered interviewing you. So, yeah, it's quite funny how AI has actually helped us in the perverse way.
Yeah, it's quite revealing. I'd argue that the best candidates do realise that AI is probably not the go-to for a cover letter, and actually putting some thought into it and personality, and that comes through and is a key differentiator. But it's interesting.
Yeah.
I mean, yeah, just in terms of hiring plans, as I said, we're pretty optimistic about how things are going to pan out for this year. But actually, the fly in the ointment there is probably AI. It's just so much of an unknown for everybody. I think most businesses are, on a bit of a continuum there, from tinkering at the one end to, deploying agentic AI at the other. For example, we ran a process at the back end of last year where we must have spoken to 15 plus CIOs, and one of the key things that came through was the lack of growth hiring plans in the team, not because the businesses they're part of weren't growing, but just because there was no need to grow. With AI being able to be deployed with automation and sort of process optimization, it's just kind of flattening the curve in terms of headcount growth. I kind of think we've got all of these kind of circumstances around potential for positive growth. It'd be interesting actually to see how that pans out in terms of hiring.
Yeah, and it's early days, right? So my use of AI has been very, very minimal. I've really struggled to get anything from it that I find interesting. Sure, it can summarize a meeting and do all those admin things that, to be honest, is not adding any value to me. Trying to get it to do anything creative, I'm really struggling getting it to write stuff that I think is well written, and anything slightly creative. Where it will help us a lot, I think, is in like the modelling space, the econometric side of things, to start with. But then I think in 3 or 4 years, maybe we are using it more and more to help us with our commentary. But for right now, it's nowhere near where we need it to be even slightly useful. So it is an interesting thing. But Kiwibank, like I think any organisation, massively into it. Trying to explore where we can use it, how we can enhance our productivity. Not through the lens of cutting headcount, but through the lens of, we've got 100 people. Let's, get AI to streamline their jobs as much as possible, so they're doing more of the high value stuff and less of the admin.
Yeah, absolutely. And I think that needs to be a sort of a conscious and deliberate thought, because otherwise this productivity gain just kind of disappears unless you're thinking consciously, how do we move to sort of a, higher order thinking skills? How do we embrace creativity, etc.? It kind of disappears. And I mean, these are teething problems, but there's an extent to which right now there's sort of a zero sum game in some respects. What somebody's gaining in getting a model to put a report together for them, they're losing when they're passing on a 5-page report versus a one-pager. In as much as these models are spitting out a lot more sort of verbose outputs than somebody might ordinarily put together themselves. But again, I think these are just early stage teething problems that get resolved further down the line once we all become accustomed to how to use it. What do you see? You're talking with a lot of businesses out there and how they're using AI and how that's converting through to productivity. So, are there any sort of insights that you've gained from that as to where things are at in terms of that maturity curve and sort of that learning experience?
Yeah, I mean, I'm hearing things across the board, right? So, a number of accountants that I talk to, it's making a lot of their job easier. It's kind of the zero effect again. So for accountants, that whole zero wave was incredible. It was explained to me from a partner at BDO. I said, so how is this impacting you? And he said, we would spend 20 hours, say, on a client, and 15 hours were, used chasing receipts and invoices and all this admin crap, and then 5 hours of advice, basically. And he said that's now flipped. So because of zero, and I imagine because of AI and all this other stuff, the admin stuff is really, really short, like 5 hours now, and then you're getting 15 hours of advice. So a client today is getting 15 hours of advice compared to 5, a few years back, and that just continues. I think that's the classic example. Doesn't matter whether you're an accountant, a lawyer, even an economist or anything out. The amount of higher value advice, higher value commentary that we can give you by gutting all that admin is just going to go up. Where it gets interesting is like, okay, well, does the lawyer need, 5, students who recently graduated to do all that grunt work that they used to do? Probably not. Maybe they only need 2. So that's where I think the rubber starts to hit the road a little bit.
Yeah, I think you're absolutely right. I think that's already coming through in the numbers. If you look at early careers, graduate hires are a fraction of, I think, 40%. The numbers came out of the UK, 40% of what they ordinarily would be. And that's, in my view anyway, clearly down to AI and the fact that you can do more with less now. So, where that gets to, I don't know. But I think there's a concern, whether it's accountants or lawyers, I think there's a big concern about from senior people that early stage graduates aren't getting the exposure that they ordinarily would do. I don't know how
Exactly.
legit that is, in as much as, yes, it's a different pathway. They're not doing the reconciliation work that they would do for 3 months straight. But if you've got smart graduates coming out, do they really need to repeat that exercise sort of ad nauseum? Or is there an opportunity for everybody to sort of move to a new frontier? As you mentioned, if partners are able to provide more advice, to what extent can they move into other areas, sort of strategy guidance or whatever it might be, and then take graduates sort of on that curve. So graduates are moving to a sort of higher order thinking level earlier than they would have done previously.
Yeah, and I think it's interesting. It sort of reminds me of a discussion I had with my father when I was a teenager, and he was like, you need to be able to do these numbers in your head. You need to be able to do long division, the old school way. And I'm like, Dad, I got a calculator, right? Like, calm down. And now you turn around and say, I've got a computer. Calm down. I think that as an economist, it's really useful getting right into the data and doing the modeling yourself, because then you come out of it with such a good understanding of that model that you've gone through. Maybe it's on the housing market, whereas getting AI to do all that and then coming into an economics team and not having been in depth into that stuff, I personally think, that's a missed opportunity. But maybe it's the same as, what I said to my old man, I've got a calculator. I don't need to do it in my head. I've got a supercomputer. I don't need to do, any econometrics. So, yeah.
Yeah, I think you're right. I mean, I think in pretty much every profession, as included, if you're not following the mental breadcrumbs towards the outcome, you've got less of an understanding of what that pathway is, and so you're less able to understand it. I think that's probably just a brain function thing. But anyway, I just wondered, we've got a few questions coming through here, and if we're talking about AI and productivity, maybe we sort of lean into that a little bit. Jarrod, what top 3 things do you think New Zealand needs to do to improve its poor productivity levels?
Infrastructure. Let me think about the second one. Infrastructure, and I'm not sure about the third, but I'll probably say infrastructure.
The 3 eyes.
Yeah. Yeah. No, I don't mean to be, facetious or anything like that. But my big bugbear has been the fact that we haven't invested in our infrastructure for over 30 years, and it just continues. So no matter how hard we pound the table that, hey, look, every time I turn on the news, there's a beach that's closed through, reasons we don't want to talk about. There's a burst pipe in Wellington. There's another traffic jam, in Auckland. There are signs everywhere. It rains a little bit too hard. All of a sudden, our infrastructure can't handle that level of rain. Yeah, it's not good enough. It's simply not good enough. So for me, that is actually inhibiting our productivity in a big way, because we can't expand the way we would like. We've got businesses that have been inhibited by the supply and the price of electricity. We're supposed to be a developed economy, right? And yet we have issues that you see in emerging countries, which is just inexcusable. So for me, the infrastructure problem, tackling the infrastructure deficit, so what we haven't done, but then even going a step further and thinking about what we need in 10, 30 years time. We just don't seem to be able to do that as a nation. And the answer is take it out of politicians' hands, put it into a fund, get some brilliant minds in there, just as we did with NZ Super, right? And then give them a long time horizon. When they've got a long time horizon, you can gear up and get things done. I use the guy who did my fence as a great example. He had one of those tractors that just smashed poles into the ground. He did my fence, and I said, "Oh, can you come back and do this extra bit?" And he came back with this massive machine that was just banging these things in. So I said, "Wow, you've spent quite a bit of money on all of this, and you've got a crew of 3." And he said, "Yeah, I've been given a 5-year contract with the council to do fences along a motorway." So I leveraged up. I bought the bigger machine. I now have so what I'm trying to say is, you give people time, you give them a long contract, and they get it done. And that's what we need to do with all our infrastructure. The academics will turn around and then say, "Oh, we're not adopting technology fast enough." Yep, there's plenty we can do there. Education can be improved, always. Health can be improved. Absolutely agree with those points as well. But what I'm saying is that we need to build a stronger, more resilient economy, so that we're not breaking down every time it rains.
Yeah, I mean, the 3-year election cycle doesn't help. But why else do you think there's a sort of a lack of political will to change it? Because there are answers out there. I mean, you just outlined a potential solution. There are others. So why are we in the position we're in?
It's really hard. It's really hard as a politician to deliver 10, 15-year ideas, right? You are in for just 3 years, and then you're lucky to be in for 6, and you're really lucky to be in for 9, right? That first 3 years, you spend the first year just trying to get things, done. And then in the second year, you're really trying to get things done. And in the third year, you're hoping that what you've done is starting to show up so that people invite you back in. 3 years is really short. They're already in election mode now in their third year. It's really hard for a government to do these multi-year projects when they don't know whether they're going to be in there for another 3 to 6 years. So it's tough. And like I said, taking it out of their hands in some sort of multi-party solution where they all say yes for the benefit of the country. We need to put money into a fund over here, and we need to give it to specialists who aren't going to be voted out in 3 years. Because when you've got 3 years, you are thinking in a 3-yearly chunk. You're not thinking about long term.
Absolutely. Absolutely. You mentioned earlier about the level of demand from China and how resilient it's been, even in the face of a sort of a lack of growth of their economy. There's a question here, curious to understand why we're not seeing reduction in demand from China yet. Also, do you see Chinese and American economies picking up in 2026?
Yes, I do. I do think China rebounds a little bit. They are putting more stimulus in. So hopefully demand from China remains quite stable, but we are seeing a pickup in demand elsewhere. We are seeing rate cuts in the US, so that will help support their economy. Like their labour market's clearly softening, but their consumer has held up really well. That they're still spending, so their household's still spending. So in terms of the products that we sell into those two of our largest markets, the demand's been quite strong, stronger than I thought out of China, and about right in the United States, and certainly not impacted by tariffs. So yeah, we're still upbeat on, we're still constructive on that global demand for our product story. But what we really need to see is the other parts of the economy recovering.
Yeah, on a kind of a related note, what opinions do you have in relation to platforms such as Temu and Shein, manufacturer to consumer, taking sales away from New Zealand businesses? Has this taken away from growth within the New Zealand economy, and if so, by what amount?
Yeah, I mean, it's another platform, isn't it? I've personally been on there and bought some cheap rubbish that pretty much ended up straight in the bin. So you get what you pay for. It reminds me of a lot of those kind of look sharp type stores where you go in there and you buy a plastic mask for $2 because you want to do some trick or treating or something. I don't think there's a lot of serious stuff on there. What does concern me is that the products that you're getting are really cheap, and they're also nasty. And I think it would be great if we could say, you know what, we actually produce some of that stuff locally, whether it's clothes or whatever. Please, buy one decent t-shirt for $30 rather than 15 t-shirts for $30 that are all going to just end up in the tip. I think it would be nice if we could somehow get people into that mindset. If we could, obviously Kiwi first. If you can shop here and if you can find it here, it'd be great to support local Kiwi businesses first. But at the end of the day, for many families who are struggling, they have to go for the $2 shirt rather than the $30 shirt.
Yeah, absolutely. Security and AI. This seems to be a big blind space that we seem very slow to run into. Do you see a risk in our approach?
Yeah, I think that's a fair call out. I really don't know, but I could imagine it's very similar to the threats that we've had in technology pretty much over my life, right? I mean, we've had these threats We've seen what it's like with hackers bringing things down. We've seen what it's like with, emails going around and inserting viruses in people's machines. And I think AI, because it's so smart, is a really big risk. Like, I think AI can trick you a lot easier than than what we've seen before. So yes, it really worries me. It really worries me. I've been sent stuff that I thought was real, and I think, could you imagine if that was if they put that sort of resource into tricking me into putting my credit card details through? I don't think it's actually as hard as you think. So yes, I'm definitely worried about that, and I'm also worried about AI's ability to hack systems and cause real damage.
Yeah, I think that's all totally valid. I think there's also an extent to which we're missing an opportunity because AI at a company level is maybe overly sort of risk averse. There's companies that are only just starting to tinker with the likes of Copilot, whereas arguably a more deliberate strategy around the management of risk could see them further ahead. So I wonder whether we're leaving something on the table in terms of the innovation and the productivity gains that we could be getting just because there's not the risk appetite there, or there's deliberate strategy around it yet.
Yeah, well, I mean, if you think about Kiwibank, for example, we are so scared of confidential data, like our client information, getting out. But we want to use AI on our client information for for a variety of purposes, which would actually serve our customers really well. But the safeguards and boundaries, and the IT team are incredibly risk averse, as they should be, for including Kiwibank data.
Yeah, agreed. I just, from what I've seen and sort of anecdotally, there seems to be sort of little fiefdoms around that are controlling access beyond just the concern about customer data. It's there's things that are getting in the way of innovation that aren't necessarily legitimate. But anyway, couple of other questions. What channels do you think are looking to experience growth? For example, food service or hospitality, and how much is tourism helping to drive growth over the coming year?
Our tourism's bouncing back. It's a good story. You speak to tourism operators and they'll tell you that it's been a really long grind out of COVID. So COVID, we're talking many years. But we're back to 95% of where we were pre-COVID. So COVID was obviously a massive disruption, and we bounced back to about 70% quite quickly, like really quickly, and a lot faster than most people thought. But then going from 70 to 95 has taken a lot longer. So, the Aussies came straight back. For example, the Chinese took a lot longer to come back. As tourists. So we're back to 95%. It's a massive part of our little economy. Tourism is actually, when it's back humming at 100%, will be slightly larger, I think, than our agricultural exports. So it just shows you how big tourism is, and that is one of the key drivers of growth over this year that we're expecting. So yeah, you're absolutely right. Tourism's key. Tourism bouncing back. People are upbeat in places like Queenstown. So yeah, that is a big part of the story. What we hope happens is that we see money coming off the farms in agri and spreading more into the regions and other areas, and then that tourist dollar also coming in and supporting other areas, maybe even a bit of retailing, maybe even a bit of construction. People going, okay, we're back to where we were. I do need to build that lodge. I do need to build that whatever for the tourist. We do need that to spread into other activity.
Yeah, absolutely. And seems to be a growth in construction jobs, regionally as well, which is all positive. What is the single biggest economic risk to New Zealand over the next decade that's not priced into current forecasts or policy settings?
Well, a lot of these risks that we talk about, none of them are priced. They're all sort of big risks that you can't actually really price into markets that well.
Mm-hmm.
So anything on the geopolitical side of things, if China really does want Taiwan or it really does want to do things in our region, which it already is, that might be something we have to face. That might be something we have to deal with. And to sit here and pretend that we can be Switzerland in that situation, we're kidding ourselves to do. And I don't mean that in a bad way. I just mean that if the US is going head to head with China, Australia's going to be obviously right behind the United States. And for us to pretend to do anything else, we'll still send our exports to China. Well, no, they won't even get past Australia. We will be part of that ANZAC, part of that ally sort of group. That scares anyone who actually thinks it through. That's quite a scary outcome, and it's not a crazy risk. I think it's there, and then there's all the other risks globally. There's risks from AI as well, right? That in order to get AI to where we want it to be, we have to generate a hell of a lot more electricity. There's a lot more rare earths and resources that have to go into creating these supercomputers and everything else. It's very resource intensive, right? At a time when we're trying to reduce our carbon footprint. So there are a lot of risks out there. For me, the geopolitical one probably worries me the most. But there are also, weather events and all that sort of stuff that are becoming, almost a daily conversation.
Mm. Yeah, interesting. Look, we're almost out of time. Just coming back to the outlook for this year. I mean, it's just you hesitate to mention the phrase green shoots, but it does sound like emerging optimism and positivity out there, and the outlook is pretty positive. Have you summing up your outlook for the year in a sentence or two? What should be our key takeaway?
I think what you just said, actually, emerging optimism. I think that's a nice way of saying it. Emerging optimism. We were optimistic last year, and it didn't happen. The second half of last year was better than the first half, but we're still nowhere near where we thought we'd be. So I think just acknowledging that and then coming into this year and going, you know what, actually, I do think things are going to pick up this time. So we won't say green shoots, but we'll say emerging optimism, and I think that covers it nicely. We're not sitting here saying we're falling back into another recession. We're saying we are growing, and it's going to take time to fully recover.
Yeah, fantastic. Well, that's a great note to end on. After 3 years of challenge for pretty much every business and everybody out there, it's nice to be able to be talking positively and looking ahead with a positive outlook. So, look, really appreciate you coming back to talk us through this and getting a snapshot of what lies ahead. Thanks everybody for joining us and giving up some time of your day. Sure you've had some useful takeaways, as have I. So maybe, Jarrod, we could book a time for 12 months' time and get you back again and see what the outlook looks like at that stage.
Yeah, that'll be great. Thank you, everyone, for dialing in.
Nice one. All right. Well, enjoy the rest of your week, everyone. Thanks for joining us. Cheers. Bye.